Good morning, everybody. Thanks for joining us. We're just going to do a quick audio test and then we're going to get going. If you can hear us, please type yes into the chat box. All right, thank you for joining our Summer CPE Learning Series. Today's webinar program will be presented by Jim Mulroy and Peggy Gallagher for our webinar Revenue Recognition for Nonprofits, an Update and Lessons Learned. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. At the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content will be answered at the end. We will do our best to address them. Please be sure to answer all of the polling questions today to ensure that you receive CPE credits for the session. Once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It's our way of being able to provide you with the best and most relevant programs possible. And with that, I'm going to turn it over to Jim and Peggy.
Awesome. Thank you so much, Ashley. And good afternoon, everybody. Thank you for joining us today to talk about revenue recognition for not-for-profits. On the next slide, you'll see Peg and I in all of our glory. The next page is our disclaimer, just a reminder that these are the personal views of Peg and myself, and not necessarily the views of Withum or the State Society or the AICPA or anybody else for that matter. These are just our personal views. So with that, let's talk about the agenda. What we'll be talking about today are some key considerations affecting revenue recognition for not-for-profits. Peg is then going to lead us through a discussion of topic 606, revenue from contracts with customers, and some lessons learned. Then I'll be talking more about ASU 2018-08, talking about more about contribution versus exchange transactions, and talking about distinguishing between conditional and unconditional contributions. And then hopefully we'll have some time for some questions at the end. If not, we'll gladly try to get back to you and answer questions after the webinar. So on the next slide, you'll see the definitions of contributions and exchange transactions. And this is really the threshold question in revenue recognition for not-for-profits. This is really the starting point in the process. So just to refresh your memory, a contribution, as you see on the screen, is an unconditional transfer of cash or other assets in a voluntary, non-reciprocal transfer. So the key there is it's unconditional and it's voluntary. So in effect, we're getting something for nothing. Contrast that with an exchange transaction. An exchange transaction is a reciprocal transfer in which each party receives and sacrifices something of commensurate value. So we're getting something and we're giving something. So really a key concept there is distinguishing between the two. Now throughout the seminar, when we talk about contributions, you may also hear us say non-reciprocal or non-exchange. All those words are referring to contributions. Likewise, when we say exchange transaction, we may also call them reciprocal transactions. Again, those are in effect just exchange transactions. So on the next slide, what we have for you is a not-for-profit revenue recognition decision process, kind of a flow chart of what you should be thinking about as you are looking at your revenue recognition. So as I mentioned, that first starting point in the upper left-hand corner is whether or not each party directly receives commensurate value. If the answer is yes, we go to the right, we have a reciprocal transaction or exchange transaction, and we follow topic ASC 606, revenue from contracts with customers, or perhaps other guidance. If the answer is no, that takes us down the flow chart. We have a non-reciprocal transaction or a contribution, and we apply the contribution guidance. So this is really a key point because depending upon the answer that you get, the accounting guidance that you use to recognize revenue will follow that decision. So just very important to understand that. So at this point, I'm going to hand it off to Peg, and Peg's going to take us through topic 606 and some lessons learned. So take it away, Peg.
Thank you, Jim, and thank you everybody for joining us. We're really pleased to have you here, and our hope is that you get some value out of this. So I am going to be talking about lessons learned from the adoption of ASC 606, aka the new revenue recognition. And as Jim just queued it up, obviously what I'm talking about in this segment on ASC 606 only applies to exchange or reciprocal transactions. So that's obviously a very important scoping matter to keep in mind. Here on this slide, I gathered my thoughts with the subtopics I want to talk about here today. And again, it's all under the theme of lessons learned. So at this point, I think most organizations have probably had an opportunity to issue financial statements applying ASC 606 if it was applicable to them. And Jim and I wanted to share the benefit of what we are seeing in terms of lessons learned so that you can strengthen the quality of your financial reporting. So let's dive in. The first thing I want to bring to your attention is some good news that came out a year ago. It was part of FASB's response to the pandemic, and they issued ASU 2020-05. And why this is good news is that for all organizations that had not yet issued their financial statements as of June 3rd, 2020, they had the option to defer the adoption of ASC 606 for 1 year. So if your organization falls into that bucket, you were permitted to defer ASC 606 through the adoption of ASU 2020-05 to year ends beginning after 12/15/19. So since most organizations have a June 30 year end, that would mean that you would be adopting it for the first time in the year that will end on June 30, 2021 at the end of this month. An important exception is the last bullet point at the bottom of the slide. ASU 2020-05 did not apply to the adoption of ASU 2018-18, which Jim will be talking about in the second part of this webcast. So do keep that in mind. Just as a level set, here are the famous 5 steps of ASC 606. Identify the contract, identify the performance obligations, determine the transaction price, allocate that transaction price if there's more than one performance obligation, and then finally recognize revenue. I will not be taking you through those 5 steps in great detail today because again, we're trying to focus on lessons learned, but just to level set, occasionally I will refer to some of the steps. Those are the famous 5 steps of ASC 606. And again, just to level set, just a quick refresher on some of the basics. First and very importantly, foremost, ASC 606 is what we think of as principles-based accounting guidance. And you're probably saying, Peg, why does that matter? Why it matters is because in many cases, applying ASC 606, because it is written in a principles-based way, is really more of an art, if you will. You know, unlike prior legacy accounting standards in other areas that have specific rules, specific criteria, specific requirements, ASC 606 is written at a much higher level, if you will, and it lays out foundational principles that each organization applies and interprets. And I caution you there with that word interprets that I just used. It doesn't mean it's the wild, wild west and you can do what you want, obviously, but it does mean that organizations, when they're initially adopting 606, do need to be thoughtful in how they apply it. Obviously, revenue is recognized. That's the purpose of it. But the underlying concept is that it's recognized when the control of the promised goods or services transfers to a customer. And that's from the customer's perspective, by the way. There are expanded disclosures, which we're going to chat about. Don't take that word contract too literally. You know, the official name of the standard is revenue from contracts with customers. In most cases, you don't need a formal signed contract, and you have to follow those famous 5 steps in a logical fashion, meaning you always start with step 1. Once step 1 is satisfied, then you go to step 2, and so on and so forth. So with those basics kind of refreshed, let's move on. And it's time for our first polling question, Ashley.
Great. Polling question number 1. Which recent significant accounting standards has or will impact your organization the most? Select one response. ASC 606 Revenue Recognition, ASC 842 New Lease Accounting, ASU 2018-08 Contributions, all of the above, or none of the above.
So please select one answer. And we have 4 polling questions, and attendees must answer all 4 in order to receive CPE credit.
Correct. All right, the votes are
Happy Friday,
collected
everybody.
in. Okay, and we're going to close out in just a few seconds, so get those last minute votes in. All right, and we're going to close out. Share the results.
You want to quickly review them, Ashley, please?
All right, so it looks like 41% voted all of the above. And then right behind that, we have ASC 606 Revenue Recognition with 30% of the votes.
Okay, that's probably just where I expected things to fall out. And I'm sure given that 41% of you said all of the above, you're probably feeling a little bit of accounting fatigue. But hopefully after this webcast, you will be better prepared to meet those upcoming challenges. So let's continue. How can a nonprofit earn revenue and have customers? Well, as Jim so wonderfully queued us up, obviously we're talking about exchange transactions. Many not-for-profits, as an example, have contracts with government agencies that request the performance of specific services, and they are paid by the government for those services. So outsourced services, commonly known as fee-for-service, is a great example of a type of transaction that is scoped into 606. However, do not default to assuming that a fee-for-service contract will automatically fall under 606. You do need to do that upfront analysis and make sure you take a look at the contract terms and see if you are scoped into 606 or not. And obviously, we're going to see this kind of thing more in social and human services type nonprofits. We're going to see it more often. But do be careful of the potential for embedded transactions. And I see this on the for-profit side of applications of 606 as well, that sometimes the devil really is in the details. You know, you do have these arrangements or contracts that will discuss a number of services, if you will, and some of those embedded transactions in those arrangements or contracts, part of it may be scoped into 606 and part of it may not. So do keep that in mind and watch out for those. Here's a list of certain kinds of revenues that ASC 606 does not apply to. If any of these are impacting you, again, they're not touched by ASC 606, and you will look to present GAAP for how to handle these. And as best as I know, in most of these, there hasn't been any recent changes, so you should be in good shape. But again, these are things that are scoped out of ASC 606. So I have an example here. It's a membership agreement. Local community center offers an annual fitness membership for $800 that includes a few things: use of the fitness facilities, unlimited group exercise classes, and free childcare. In 2021, in order to entice their members to come back, they have a promotion and they're providing new members with 2 personal training sessions with a certified personal trainer. Those sessions are also offered individually, a la carte, and are available to members and non-members for $100 per session. So questions I want you to think about is this scoped into ASC 606? And if so, what are the performance obligations and what would the revenue recognition method be for each? And so clearly this is an exchange transaction. It has that reciprocal nature. So it is scoped into ASC 606. The performance obligations are obviously the personal training sessions. Each of those 2 training sessions are a separate performance obligation. And as each of those sessions occurs, the organization will recognize the associated revenue for them. And then the basic membership, for purposes of this example, we're going to assume is just 1 performance obligation. and that would be recognized straight line over time. In some cases, depending on the nature of that basic membership, there may be more than one performance obligation there. So that's where, again, that upfront thoughtful analysis would be key. As far as applying ASC 606 to this example, that $800 would be allocated among the 3 performance obligations based upon their relative fair value. ASC 606 requires us to develop that fair value if it's not already posted and available. And you would credit, if you collect these fees up front, which you would in most cases, you would credit them to deferred revenue, which is a liability, also known as a contract liability under 606, and park them there until the revenue recognition occurred. Let's talk a little bit about advance payments because that example queued us up for that. So previously, a not-for-profit would typically record the advance payment as deferred revenue, and the revenue would usually be recorded over time as the work was performed. Now, with the advent of 606, an organization has to perform an analysis to determine if this advance payment should be treated as revenue from a contract with a customer or a contribution. And obviously, if it's revenue, you go into that 5-step analysis and recognize revenue accordingly. Let's drill down a little bit further into that topic and talk about amounts due prior to the provisions of services, like in our example. Some non-cancelable contracts do require advance billing, so we have that scenario as well before the provision of the underlying service. Great example of that is a school that charges tuition. Under ASC 606, you would recognize a receivable when you have that legal right to bill. You would also offset that by recognizing a corresponding contract liability. Again, that's 606 speak for deferred revenue. And that's only when the contract becomes non-cancelable. The thinking is there that the entity has an unconditional right to the consideration. So some of you may think, wait a minute, that sounds like grossing up my balance sheet, if you will. However, the thinking under 606 is that the organization has an unconditional right to that consideration, and it's got to be provided for. So now let's move into disclosures, and this is where I think as far as lessons learned go, this is what we have seen here repeatedly with respect to ASC 606. Because it is a principles-based standard, the offset to a principles-based standard is more and enhanced disclosures so that users and readers of the financial statements can get that necessary transparency into the key judgments that the organization made in applying that principles-based accounting standard. So improving ASC 606 disclosure is definitely an important lessons learned. On this slide here, I've just kind of put together a laundry list of the ones that we are seeing in particular. Don't forget to disclose that total amount of revenue from contracts with customers if it isn't already separately disclosed in a financial statement. The opening balances of all receivables, deferred revenues, aka contract assets and contract liabilities, and any contract costs, 606 contract costs, the opening balances of those as well as the ending balances of those have to be disclosed. Disaggregation of revenue may apply to your organization. In particular, if you have 606 revenue that is recognized over time as well as at a point in time, those two buckets have to be disclosed. You may also be required to disclose qualitative disclosures that depict how the nature, the amount, the timing, and the uncertainty of the revenue and cash flows are affected by economic factors. So a great example of that is that if you have revenue arising from different geographical regions or countries, if you have revenue arising from very different types of customers. So, and that's a qualitative disclosure, you guys, so no numbers attached to that particular one. Clearly disclose what the performance obligations are, clearly disclose what the method or methods of revenue recognition is. If it is over time, you're going to have to drill in a little bit more and provide disclosure around how that over time revenue recognition is being applied. Is it on a straight line basis? Is there a formulaic approach? And also, very important, how revenue versus contributions was allocated and determined. You need to give some color into that. If you have variable consideration, There are disclosures that attach to that as well. And then in general, if any of the other buckets haven't captured it, if there's other significant judgments that were applied in implementing ASC 606, that should be disclosed as well. So a lot of ground to cover in disclosures. I thought it would make a lot of sense to walk you through some good examples, and also then you would have these examples to take away. I want to give credit to the AICPA, which is where I pulled these from. So let's walk through a few of these quickly, and again, they're yours to use and tailor going forward. So the first one here is an example of a cost reimbursement grant conditioned on meeting expenditure requirements. This would probably appear in the entity's accounting policies. And I want to point out here that even though the organization's underlying RevRec policy may or may not have changed from before they adopted ASC 606, this is still required to be disclosed because it's their accounting policy. And again, principles-based standard gives the reader, the user of the financial statements, that insight, that transparency into it. So it lays it out pretty nicely, I thought. So that's one good example there for you to refer to. Here's another one. In this case, it has to do with ticket sales. And they're a membership organization, so they have membership dues as well. And so they're disclosing, some of the key things to communicate. The dues are non-refundable. The dues are an exchange transaction, so we're hitting that requirement right there. They're recognizing and disclosing that the membership dues are recognized over time, over the membership period. The part of the membership dues that is deemed to be a contribution, a non-exchange transaction, is recognized immediately. So they're disclosing that as well. And then apparently this organization also does other special events outside of the membership dues. And so they've disclosed their RevRec policy for those as well. So not too many words here, really just a few short sentences, covering a lot of ground and checking a lot of the disclosure requirement boxes as well. In this example, which would also appear in accounting policies, this is an example of a school with student tuition and fees and room and board. And I thought this did a really, really nice job of identifying the separate performance obligations, of identifying the underlying theory that they're recognizing the tuition revenue over time as the educational services are being delivered, air quotes, if you will, around that word delivered, because as the educational services are being delivered, they're being received and consumed, again, air quotes, by the students. Again, that foundational concept of recognizing revenue when control of the good or service has been received by the customer. They're also talking about their housing and their meals, because that's something that this particular institution does. They're talking about how they're grouping all their contracts, because apparently they're prototype contracts. And so they looked at them on a portfolio basis, if you will. They've disclosed that the payment is due in advance, and they're talking about, their deferrals as well. So, and lastly, scholarships. So I thought this one, again, checked a lot of those disclosure requirement boxes in a brief and concise yet clear way. And here's an example of a homeowners association. Some of you may be associated with those. Interestingly enough, ASC 606 had a big impact on homeowners associations. Like, who knew, right? But I really like this disclosure because it's talking about all the various responsibilities that the homeowner association has, how the related revenue for those is recognized, what kinds of related revenue the homeowner association has, and they're doing that in the middle of the slide: recreation programs, facility rentals, etc. And then lastly, they're closing it out with a discussion of how they're handling homeowner assessments paid in advance. So that's some examples of qualitative disclosures. Here's an example of a quantitative disclosure. If you remember, I was pointing out a requirement to disclose the opening balances of certain things. So some organizations choose to do that in a table. It's not required to be in a table. It can be done in a sentence. But if you like the idea of doing a table, here's a great example for you. This one has to do with contract liabilities only, but it could be applicable for contract assets and contract costs as well. And that takes us up to polling question number 2, Ashley.
All right, polling question 2. What is your role at your company/organization? Controller, VP of Finance or CFO, accounting manager, educator or external auditor, or other?
And again, just a little reminder, this is the second of our 4 polling questions, and all 4 must be answered in order to receive credit.
All right. Give it just another second, and then we'll close it out and share the results. Okay, and we're closing it out. So the results are in. Other is 36%, controller at 26%, VP finance, CFO 21, and then we have accounting manager, and lastly, educator or external auditor.
Nice mix, great mix. Thanks for sharing that information. You know, it's always helpful for Jim and I to know who's in our audience, so thank you for sharing that. So just the last few slides under the topic of lessons learned from ASC 606, and we're going to move away from financial reporting and speak a little bit about all the very, very important but background things. And one of the first things that came to our minds was this is a great opportunity now that you know, day 1 of 606 is behind you, to think about if you need to enhance your documentation and your accounting records. So just some examples. This is a great opportunity to catch up your internal control documentation for ASC 606, right? When you're doing that, this is a favorite thing of auditors, so just a little heads up here. Make sure that you emphasize internal controls as opposed to process steps. Process steps, obviously very important for the understanding, but internal controls are really the meat there. You also want to make sure that your documentation and your underlying policies and your controls are able to enhance and promote early identification of any ASC 606 revenues, particularly in embedded transactions, if that's applicable to you, or in new kinds of contracts or revenue streams. Think about if your last audit highlighted any pain points in your accounting system. For example, did you struggle disaggregating and coming up with a total for the ASC 606 revenue? Did you struggle, was it a challenge to gather all the data for the ASC 606 disclosures? Those are just a couple examples, but you know, do think about, you know, if there's any pain points there that you need to circle back to and strengthen. Lastly, several of our clients have seen this 606 look back lessons learned chapter as an opportunity to improve some of the language in their standard contract form or their standard agreement form. You know, there's been instances where the application of 606 highlighted some aspects of these agreements that wasn't necessarily thoroughly documented. So this is a good opportunity to go back and clean that up, if you will. Just as a quick review, we've seen some struggles with this as well. I've listed on this slide some things that are usually not performance obligations. That step 2, determine the performance obligations, is probably the most challenging step for most organizations because it's the most heavily theory-based step. And in particular on that topic, I want to talk about customer options versus something called a material right in ASC 606. So a customer option is really just that. It's almost like a marketing offer, if you will. It usually does not represent a promise to a customer, and it's something that at its core the customer may choose to exercise or not. Watch out for something that occasionally pops up called a material right. It is a performance obligation. It is really an embedded promise, an obligation that your organization has to your, air quotes, customer. It usually involves free or significantly discounted goods or services in the future. So do watch out for those. I've seen some pain points with that. Another step, the last step, recognizing revenue that can be problematic is, do I recognize my revenue over time or at a period of time? This is one of the few places that 606 did give us some criteria. So if any one of these three things is met, you are kicked into recognizing revenue over time. So I hope this slide is helpful for you in figuring that out going forward. And at this point, I'm going to turn it over to Jim. Take it away.
Awesome. Thanks so much, Peg. That was a great discussion. So I'm going to dive into the contribution accounting under 2018-08. And on the next slide, you'll see some background and scope. And what's interesting is some of the things that came to light that were clarified in 2018-08 were really a result of FASB putting together Topic 606, Revenue from Contracts with Customers. And one issue that kept popping up was this issue with government grants and contracts. Whether or not a government grant can be a contribution or an exchange transaction. And there's a lot of diversity in practice. There were some organizations that felt that a government grant, even perhaps a cost reimbursement grant, was always an exchange transaction. There was this thought that the government does not make contributions, and that the government, by issuing grants to not-for-profits to help with, for instance, social services, really, in effect, the government was getting a benefit by assisting the general public. And what we'll learn is that ASU 2018-08 tells us, no, the government can make contributions, and certain transactions, including government grants, should be treated as contributions. And we'll talk more about that later on. The ASU also helps us distinguish between conditional and unconditional contributions, as well as donor-imposed conditions and restrictions, clarifying some of the rules that date back to the old FASB 116 and 117. On the next slide, just some more background information. This ASU does apply to all entities, both not-for-profits and business entities that receive or make contributions. It does not apply to transfers of assets that are in substance purchases of goods or services. But parenthetically, I have a little note there: be aware of inherent contributions. Sometimes you may be receiving goods or services that's substantially below market value, and there may be an inherent contribution in that transaction that you need to be wary of and need to account for. The ASU excludes transfers of assets from the government to business entities, and it applies to both contributions received by a recipient and contributions made by a resource provider. So this covers both grant recipients and grant makers. So just be aware, it's both sides of the equation, grant expense and grant revenue. There's the effective dates on the next slide. For all recipients, this should be old news and it's been effective already. For resource providers, many resource providers adopted this early so that the recipient and resource provider accounting kind of matched up. For those of you that are grant makers that have not yet adopted, you're going to be in the bucket now for calendar 2020. And with that, we've got our next polling question number 3, Ashley.
All right, polling question 3. How familiar are you with the concepts surrounding contributions discussed in ASU 2018-08?
Let's see how many Mets fans we have.
All right, everybody, we're going to close it out in just a second. Get those last votes in. All right, and we're closing it out. The results are 42% somewhat familiar, 29% right behind that with not familiar at all, and then we have very familiar, and lastly, how about those Mets?
All right, well, that's really helpful to know. We've got a pretty good mix of understanding, and hopefully for everybody in those categories, I can help elevate your understanding a little bit, but I can't help the Mets, but that's what it is. So the next slide talks about, again, some indicators about contribution and exchange transactions, but really the key factor to understand is that first bullet under the exchange column is whether or not commensurate value is transferred between both parties. There needs to be a direct benefit. That really is the key concept. And on the next slide, we talk about that a little bit further. In terms of what commensurate value is, who benefits, does the resource provider, does that grant maker receive commensurate value? And the first bullet talks about the resource provider is not synonymous with the general public. If the resource provider receives value indirectly by providing a societal benefit, this would be considered a non-reciprocal or a contribution transaction. So this kind of goes back to the background that I set up regarding 2018-08. This is basically telling the reader, by the way, if a government agency provides a grant to a not-for-profit for social services, for instance, well, that's great for the public. The government is not receiving a direct benefit. It's not enough to create a direct benefit, and therefore it's still treated as a contribution. So that's kind of what that's driving at. The second bullet there, execution of the resource provider's mission with a positive sentiment from acting as a donor does not constitute commensurate value received. So, think about perhaps a healthcare foundation that provides an award or a grant or a contribution to a not-for-profit to help people, educate people about maybe their healthcare insurance options. So certainly, the healthcare foundation, we are helping their mission by educating the public about healthcare insurance options. But the healthcare foundation is not receiving a direct benefit. We're really furthering their mission. So, in that case, there is not direct benefit. It's not an exchange transaction. It would be under the contribution accounting. And finally, the type of resource provider should not override the substance of the transaction. Again, whether or not you're a government, a foundation, a corporation, an individual, the type of resource provider making the award, making the contribution, does not change the facts and circumstances, does not change the decision process, for instance. The next slide is kind of just a visualization of the types of exchange and non-exchange transactions that you can have. As I mentioned, this is kind of a clarification from the old FASB 116, 117, which governed the accounting for contributions before this standard. So under the exchange side, you'll see that, to the extent there's direct commensurate value to the resource provider, we have an exchange transaction. We'd be under topic 606, as Peg just discussed. To the extent we have a specified third party, where the resource provider is a third party payer on behalf of an identified customer, we also have an exchange transaction. And I'll talk more about that shortly. And then on the non-exchange side, we have those transactions where the award is benefiting the general public, but it's not directly benefit. There's no commensurate value being exchanged with the resource provider. So that would be a contribution. And then other types of third-party transactions that are not on behalf of an identified customer. Under the old standards, that portion in green on the right, the general public, for many organizations, would have been under the exchange accounting side. So that was probably the biggest change with this ASU, is to clarify that those types of things that benefit, those types of awards that benefit the general public are contributions, not exchange transactions. So on the next slide, I want to just talk more about this specified third-party element of exchange transactions. And what it tells us is that certain transfers of assets should be treated as part of an existing exchange transaction between a recipient and an identified customer. And there's some examples there, Medicare and Medicaid programs, for instance. In effect, there is an existing contractual relationship between perhaps the patient and the healthcare provider. That really is a contract, whether it be written or implied. There is a contract, and Medicare and Medicaid may be paying certain benefits for that patient, but that's not a separate transaction. Those Medicare or Medicaid payments are part of the existing exchange transaction between the patient and the healthcare provider. Likewise, Pell Grants and similar tuition assistance are treated the same way as part of the existing exchange transaction. There's probably a contract between the student or the student's parents and the educational institution. To the extent that there's tuition assistance, that tuition assistance is really part of that same contractual relationship and is treated as an exchange transaction. And the final example there is affordable housing. To the extent that a tenant has a lease with a housing provider, and perhaps there's tenant subsidies whereby the government is paying a portion of that lease, of those rental payments, that likewise would be considered payments on a specified third party and is part of that same exchange transaction. So definitely an important thing to understand as you go through your decision process. So next slide, I just wanted to bring back this decision process flow chart again. So we've already decided that where we are if we have an exchange transaction or a non-exchange transaction. The next question is, do we have conditions present? Do we have a conditional contribution or do we have an unconditional contribution? Talks about whether or not transaction is conditional or unconditional. And as you see there, a donor-imposed condition is one or more barriers that must be overcome before the recipient is entitled to the assets transferred or promised. And there's a right of return to the contributor for assets transferred or a right of release of the promisor from its obligation to transfer assets. So it's important to realize that you need to have both a barrier and a right of return. And what's important also to understand is many foundations, what I find is that right of return language, basically saying if you don't spend the money for the purposes of the grant, you need to return it to us. Many foundations or other institutions use that language, as a standard boilerplate language in all their agreements. But the key question is there also a barrier? Is there also conditions you need to overcome to be entitled to those funds? So just realize that you need both for it to be a donor-imposed condition. The next slide, actually you can go one more to the conditional, So here what we have is a really key concept is that first bullet point. And that is that conditional contributions are not recognized as revenue until the barriers to entitlement are overcome. So another way of saying that is conditional contributions are not recognized as revenue until the condition is met and they become unconditional. So this is really a key concept because this can really affect your overall revenue recognition. Take the example where, we may have an award for $900,000 and it's payable $300,000 over each of the next 3 years. The question becomes, do you recognize $900,000 on day one, or do you recognize $300,000 in each of the next 3 years? And the question is whether or not there are barriers to be overcome for you to earn those additional payments in the future or not. So this concept of conditional versus unconditional can really have a huge impact on your financial statement revenues. So it's really a very big decision. So make sure that you're on solid ground as you do your analysis. A probability assessment about whether the recipient is likely to meet the stipulation is not a factor when determining whether an agreement contains a barrier. So what this is driving at is, if you provide meals to the homeless and you typically provide, maybe 12,000 meals a year to the homeless, and you get an award that says, you don't earn this award until you provide 1,000 meals to the homeless. You may say, well, I provide 12,000 meals a year. Certainly I'm going to provide the 1,000. I can recognize this as revenue right away. And what the standard kind of makes clear and clarifies is you should not recognize that revenue until you actually provide the 1,000 meals. You cannot make a probability assessment. Now, certainly to the extent that this all happens within the same fiscal year, it doesn't make a difference. You're still going to recognize the revenue. But to the extent some of these agreements maybe straddle your fiscal years, it could make an impact on when you recognize revenue. So just be aware of that. And then finally on this slide, it tells us that in cases of ambiguous donor stipulation, a contribution containing stipulations that are not clearly unconditional shall be presumed to be a conditional contribution. So the default is, if you're not sure if it's conditional or unconditional, treat it as conditional. So on this slide here, we demonstrate some indicators that a barrier may exist. Interestingly enough, the word barrier is not defined, but this kind of tells you what a barrier is. So the inclusion of a measurable performance-related barrier or other measurable barriers, such as a specified level of service. You must provide X number of meals, or you must serve Y number of patients. That generally is deemed to be an indicator of a barrier. The second bullet there, the extent to which a stipulation limits discretion by the recipient on the conduct of an activity. So to the extent an agreement gets into the how you deliver the service, for instance, when it gets into the how, that's a bit more controlling and may represent a barrier. A classic example is qualifying allowable expenses. So for instance, if you have a single audit and you're subject to uniform guidance rules, those rules are generally deemed to be, somewhat restrictive. There's cost principles involved that you must follow. Those are kind of limit your discretion on how you operate the program. Those would usually be deemed to be a barrier. If you need to hire specific individuals, or there's certain protocols that you must follow, those are often expected to be a barrier. And finally, the extent to which a stipulation is related to the purpose of the agreement. Kind of said another way, if there are administrative tasks or trivial stipulations identified in the contribution agreement, those generally are not deemed to be a barrier. If you need to submit a quarterly expense report, in and of itself, that's not deemed to be a barrier. If you need to report the number of meals served, for instance, that by itself is not a barrier. If you must provide a certain number of meals, that would be a barrier, but the actual reporting may not. And we've got polling question number 4, Ashley.
All right, polling question number 4. The implementation of ASU 2018-08 affected the timing of revenue recognition of contributions at my organization significantly, moderately, very little, or not at all. All right, this is the last polling question for the day. Make sure to get in your votes. All right, and we're going to close out in just another second. And we're closing and sharing the results. So it looks like very little came out on top with 39%, and then not at all, moderately, and significantly.
Okay, great. That's very interesting. Yeah, I think, later on we'll discuss some takeaways and lessons learned. I think the lessons learned is that you still need to document what your decision-making process is, even if revenue recognition hasn't changed. That's very interesting. That's helpful. So I want to talk about donor-imposed conditions versus donor-imposed restrictions. Sometimes it's difficult to distinguish between the two, whether or not a particular transaction or stipulation is a condition or a restriction. So I wanted to try to talk about that and just try to clarify that a little bit. So donor-imposed conditions, we've kind of spoken about types of barriers, that it represents a barrier that must be overcome before the recipient is entitled to the assets transferred or promised. It's a limitation on how the activity is conducted, or there's a measurable barrier that's contingent upon a future performance or perhaps a future event. So that's a donor-imposed condition. A donor-imposed restriction specifies a use of the contributed asset that's more specific than the broad limits resulting from the nature or mission of the not-for-profit or the environment in which it operates. So when you talk about donor-imposed restrictions, we're usually getting to things that are, that the assets must be used for a particular program of the not-for-profit or a particular service. or perhaps there is a time frame in which the not-for-profit recipient needs to spend the funds in. Those are typically restrictions. So, if you're a daycare center and someone writes you a check and says, these funds must be used for your daycare center, well, that's what we do. So that's not really a restriction. But if somebody writes us a check and there's a letter attached that says these funds must be used to provide meals for low-income children, or these funds must be used for your ESL program, for instance. Well, those are a bit more narrow than our overall mission, our overall environment, and those would be deemed to be restrictions. So hopefully that kind of clarifies that a little bit. On the next slide, just want to talk about some timely issues. Paycheck Protection Program. Hopefully many of you are aware of this, but there's really two options for treating the PPP loan. One is basically treated as debt, and you leave it on the books as debt until you've got forgiveness by the SBA, as well as forgiveness by your bank. And at that point, you would recognize it as income. The second option is that you can treat it as a conditional grant. You can in effect say, the SBA is providing us with a grant, but there are strings attached. There's eligibility and there's allowability issues. And you can treat it as in effect a conditional grant, and you can recognize revenue on that SBA loan as you meet the requirements of the program. So there's two different options there. I gave you a reference to a TQA that gives you more information on that treatment. Interestingly enough, employee retention tax credit comes up quite a bit. I think the employee retention tax credit can be treated the same way, in effect, as a conditional contribution. And once you believe that you've met the terms of the program, you can recognize that as revenue. We've been getting a lot of questions about how do you treat that credit? Is that a reduction of payroll taxes? Is it revenue? Do you show it gross? Do you show it net? And we believe you should show it as revenue, and that gross presentation is always preferable for financial statement purposes. So just want to quickly talk about some lessons learned on the next slide. As Peggy kind of mentioned, documentation is really important. You need to document your decision-making process and conclusions. Especially if you've got material awards, material transactions, or new awards, new transactions, you want to make sure that you document what your process is, what your decision-making process is over those transactions. You want to be sure to discuss new or unusual transactions with your auditor to avoid surprises. Make sure you're on the same page in terms of whether or not it's an exchange transaction or a contribution, whether or not there's conditions or it's not, or it's unconditional. Just make sure you're on the same page to avoid any surprises later on with your auditor. As I discussed, you cannot use a probability analysis or the likelihood of overcoming a barrier. You recognize revenue when you overcome the barrier. You need to use the language in the funding agreements as the basis for conclusions. You can't say, well, what they meant to say is, or what we've always done is, the words matter in the agreement. So if those agreements don't kind of match what you're actually doing or what the understanding is, we suggest that you consider having that language updated. And similar transactions can be treated differently depending upon the language. Don't think that all grant contracts are going to be treated the same. Don't think that all fellowships are going to be treated the same. Certain subtle differences in the language can really affect the outcome of the revenue recognition process. So do make sure you're looking at the language in your agreements to make sure it matches what you're doing. The next slide, we discussed contributions and multiple payments. That certainly is something that I find consistently to be an issue, whether or not you've earned the right to those additional payments now, or if there's additional barriers you need to overcome to earn those future payments. So do be aware of that. Financial statement captions and funding agreement titles don't determine the accounting treatment. So you can have grant awards, grant income that can be treated as exchange transactions. You can have grant income that's treated as contributions. Likewise, on your funding agreements, you may have funding agreements that are entitled, contribution agreement or sponsorship agreement or contract, but those titles don't dictate the accounting. The terms and the words in those agreements dictate the accounting. And then finally, be alert for transactions that are part exchange and part contribution. Peg went through this nicely, talking about things like membership dues or special events or even sponsorships. We're kind of used to this concept where, this part exchange and part contribution. You need to kind of bifurcate those transactions between the two types of accounting guidance and account for them separately. So be aware of that. And with that, I'll pass it back to you, Ashley.
Alrighty, if you can flip to the next slide in a second, these are our lovely presenters for the day's contact information. Thank you to you two, you did a great job. We hope everybody enjoyed it. And then just as a reminder, we have a really awesome podcast called Civic Warriors, so hope to check us out and make sure you just take our survey when it pops up after we close out for the day, and we're happy to have had you. Everybody stay safe and enjoy your weekend.
Thanks, everyone.
Thanks, everybody. Take care.